Hey there, ACCA Performance Management students. I'm Steve Willis, and I'm going to take you through scenario Mylo from Practice Exam number 1. This is a Section B question. It's quite challenging. It's quite time-consuming. So before you watch this video, make sure you get into that Practice Exam number 1 in the practice platform. Try this on your own, then come back and continue viewing the video, and we'll go through it together. Welcome back, guys. Before we get started, quick review of the exam approach. You start with Section A, then you move to Section C, and you end here in Section B. These can be the trickiest and the most time-consuming questions in the exam. Okay, so we're now towards the end of the exam when we're doing Section B. We're checking out this question, Mylo. Remember, time management, 1.7 minutes per mark. You've got 10 marks for this scenario, so that's 17 minutes for the entire scenario. There will be a range of difficult and easier questions here. So it's really important that you do the easy stuff first, and then you want to run out of time in the trickier, more difficult questions. And when you run out of time, go to the next scenario, scoop up the easy marks. That's the approach. We're looking at Mylo. We see that it's all about decision making under uncertainty, risk and uncertainty. And starting off, first question is asking about maxi-min. That is the decision-making rule for the risk-averse decision maker, and I can't help but exploit the first easy question here. Okay, so I'm going to go to the demand levels first. I'm going to find the worst case scenario. Well, the worst case would be, okay, if only 450 lunches were sold. If we assume the worst case demand, okay, my best decision would be to supply the 450 lunches. That gives me the highest profit, guys. So answer, guys, is 450. Easy peasy lemon squeezy. We exploited an easy one right out of the gate. Let's go to the next question. Question 17. Okay, and I'm going to check out the requirement over here. If Mylo adopts the decision rule of minimax regret, what supply will I choose? Well, you guys, this is going to be quite tricky because we need a regret table. And the story here is giving me a payoff table of profits. So in order to do this, we've got to turn the profit table into a regret table. That's going to be a lot of little calculations, guys. It's going to be a lot of busy calculator work. I don't want to do that now. Let me keep scrolling through the screens. Maybe there's something easier to do before I get into that. And look at this. Question 18. That's a theoretical question, so let's do that now. Okay, those tend to be easier and solvable in less time than the numerical ones. We're looking for 2 correct statements related to expected values. That is the decision-making tool for the risk-neutral decision maker who will rely upon the probabilities. Right off statement 1, Mylo is taking a risk-averse, a defensive or conservative approach to the decision. That, guys, is false. That would be maximize the minimum profit. Don't like the first statement. Expected values will ignore any variability which could occur across the range of possible outcomes. Okay, I like that one. That one is true. If we want to look at the variability, we need to use a different tool. We would need to use standard deviation there. Okay, so expected values look at the probability, but it doesn't look at how spread out the different results are. Expected values, looking at the next statement, expected values will not take into account the likelihood of the different outcomes. Well, you guys, it's based on the likelihood or the probabilities. And the last statement, expected values can be applied by Mylo because he's evaluating a decision which occurs many times over. It's a repetitive decision about how many lunches should they make in a day. Okay, so that one is correct. We don't like expected values for a one-time long-term strategic decision, but we do like it for a repetitive decision, such as how many meals should we make in a day. Answer, guys, are those two. We've tackled 2 questions out of 5 so far, making good progress, doing the easy things first. Well, I've cleared 2 out of 5 questions, the 2 easier, and I've evaluated the remaining questions, and we've got to get started working on the more difficult questions. So we're going to try now question number 17, okay? The question about the minimax regret. This will be a little time-consuming and calculator-intensive. What we need to do in order to use the minimax regret approach, we need to convert the payoff table of profits into a regret table of opportunity costs. Okay, and I'm going to show you how to do that. So we essentially replicate the rows and the column headings of the payoff table. So we can do that right in this space here. Let me start with the column headings, and we take the column headings right from the payoff table. So that would be 450, 620, 775, and the 960. Then I'll reproduce the rows, and those are the same figures, the 450, the 620, the 775, and the 960. Okay? Now, if you remember, this is the supply. This is my decision. And what I'm going to do is look at the opportunity costs of making the wrong decision under each demand level. Okay, so it works like this. I'm going to go across the demands starting with 450. If the demand is 450 and I choose to produce 450 lunches, then I earn a profit of 1170, which is the highest profit. So there is no opportunity cost. I have no regret of that decision. However, if I choose to produce and supply the 620 and demand happens to be 450, I only earn 980, guys. So now I have a regret. I have an opportunity cost. I say, oh, shucks, I should have produced 450, but I produced 620. So the difference there between those two profits is my opportunity cost, or a 190. Now I do the same thing. If demand is 450 and I produce and sell the 775, I only earn 810. I could have earned 1170 had I produced 450. So I made the wrong decision, and my opportunity cost from that course of action is the difference of those figures, which is the 360. Last but not least, if I produce and sell the 960, I only earn 740 profit. And if the demand is 450, I could have earned more, but I didn't from making a bad decision. The opportunity cost of that decision, 430. Guys, that is how it works. I'll do a little bit more with you, and then you do the rest. If demand turns out to be 620, right here, right? 620. And I decide to produce 620. Wow, I have the highest of the profits under that demand state, and I have no opportunity cost. I made the best decision. However, if demand is 620 and I produce 450, I'll only earn 1170. Opportunity cost, okay? The cost of choosing the wrong course of action, that would be a 442. Guys, that's how the regret table works, comparing, okay, the profit of the wrong decision versus the profit of the best decision, the difference, the opportunity cost. Okay, so I'll plug in the rest of the figures. All right, so I finished doing the math, and I now have a table of opportunity costs, or my regret table. So what I do last is I look at my 4 decisions, and what I would like to do is minimize the maximum regret, or minimize the maximum opportunity cost. So all I have to do is go through each decision. Now I go down the columns, and I find the biggest regret, and I can just circle that, right? So biggest, if I produce and sell 450, is 13260. Next would be 884, biggest number in this column, 481, and 430. So I've identified the maximum regret under each decision, and I would like to minimize the maximum regret, okay? Smallest regret is the 430. So if I would like to minimize my maximum regret, I'm going to produce the 960. There you go. Guys, that's time consuming. That's going to take a lot of moves on your calculator. So you really need to practice being accurate and moving quickly. Answer 960 for question 17. Okay, friends, moving on to question 19. Now we're going to tackle the value of perfect information. Again, a labor-intensive solution we'll need to craft. If we're doing the value of perfect information, the first step is this. Imagine if we have a magical crystal ball that will tell us what the demand will be, okay, in advance. We go through and we select the best profit for each demand state and multiply that by the probability of that demand state. Okay, so check it out. If we knew that demand would be 450, I would choose to produce 450 and earn the 1170. Guys, there's a 15% chance of that happening. First thing we'll do is multiply the 15 by, this is the 15% by the 1170. So there's a 15% chance we're going to earn 1170. Now, if we knew that demand was going to be 620, well, I would supply 620 and earn the 1612. Guys, there is a 30% chance of that happening, right? So I'm going to multiply the 0.3 by that. Okay? Now, if we magically knew that the demand would be 775, well, I would make the best decision and I would produce and sell 775. And there would be a 40% chance of me making that decision. Now, if I magically knew that my demand would be the highest, the 960, well, then I would produce the 960 and earn the profit of 2496. There's a 15% chance of that happening. So if I get the product of the probability multiplied by the best profit of that demand, and I add those together, that is the expected value of profit with perfect information. Okay, and that figure is coming to 1839.5. That's the expected value with perfect info. That's the 1839.5. Now, if we didn't have access to that magical crystal ball, we'd have to use just the expected value tool without perfect info. So we're going to check the expected value of each profit under each decision. And let me show you how I do that. That's what you're probably more familiar with. So now, if I produce 450 units, there's a 15% chance I get 1170, 30% chance, 40% chance I get 1170, and a 15% chance, right? So that one's easy. The expected value of my profit under 450 is essentially 100% times 1170. So that's going to be 1170. Now, if I choose to produce and sell 620, okay, there is a 15% chance that I will earn 980, and then I can just add up these probabilities, and that's going to be 85%, right? The difference, those add up to 100. So the balancing figure between 100 and 15 is 85. So I multiply 85% times the 1612. So 15% of 980 plus 85% of 1612. And that comes to 1517.2. Okay, 1517.2. Now, if we decide to produce and sell the 775, okay, well, that's going to be then the 15% multiplied by the 810, the 30% multiplied by the 1395, and the balancing figure this time will be 55%. 15 and 30 is 45, so the balancing figure is 55% multiplied by the 2015. We add up all of those products, and we get a 1648.25. And using the same approach, okay, the expected value then of the 960, I've run out of space there, so that's going to be a 1586.4. A lot of math. So I've done the expected value of each supply level, and I want to choose the highest figure. That's this one, the 1648.25. So coming back to my template here, that's going to be the expected value without perfect info, 1648.25. And the difference, guys, is the value of the perfect info, which comes to 191.25. And remember that you have 17 minutes, right, for this entire scenario. So if you're running out of time right now, I feel your pain. It's normal. These are difficult questions. Stop what you're doing after this question and go to the next scenario and get the easier ones first. Keep it moving. If you get bogged down in one of these and you have to redo this whole thing, you could clear 3 easier objective test questions in the next scenario in the time it might take you to recalculate this one. Okay? But let's be thorough. Let's move to the next question and do that. Let's tackle question 20, the final question in the Mylo scenario, and again, it's quite number calculation intensive and time consuming. Let's go statement by statement. So the first statement is testing your knowledge of sensitivity analysis. And that means that's all about how sensitive is the profit to a change in a variable. The two variables that we need to compare are the sales volume versus the price. Okay, so to test the sensitivity of profit to a change in the price, we simply divide 385 by 1300. And that comes to 0.296 or 29.6%. Okay, so that tells us that the selling price can drop 29.6% and will break even. Now, if we'd like to check the sensitivity of profit to a change in volume, well, that's going to affect both the price and the variable costs. If we sell fewer units, we earn less revenue, but we also incur fewer variable costs. Okay, so now it's going to be 385. That's the sensitivity of profit to the change in volume. That's going to be the 385 divided by the 455, and that comes to 0.846. Okay, so that tells us that the volume can drop 84%, 84.6%. So the first statement is false. The investment is more sensitive to a change in volume than price. Nope, we just proved that the investment is more sensitive to the price, the 29.6%. Let's check the next statement, and that's the sensitivity of the profit to the variable costs. Okay, so now we just need to divide the 385 by 845, and we get 0.455. So statement 2 is also false. We just found out that the variable costs need to increase 45.5% to break even. So if variable costs increase by 44%, they make a small profit. The next one is checking the investment's sensitivity to a change in fixed costs. So we divide the 385 by 70, and we get 5.5 or 550%. So third statement is true. And the fourth statement, boy, this is a lot of work, this question, a lot of calculations. Margin of safety. If you remember, what is the margin of safety? That is the drop in activity level from the current or the budget to the break-even point, or how much can our activity drop before we break even. Okay, we're currently at 650 units. That's what my budget is based on. To get the break-even point, we need to divide the fixed costs by the contribution per unit. That is the classic formula for the break-even point. And let's do that. Do we have the fixed costs? Yes, we do. The incremental fixed costs? Sure, we do. Could we get the contribution per unit? Sure, we could. We could divide the 455 by 650. So that's the math that we'll need. My incremental fixed costs are $70. My contribution per unit would be the 455 divided by 650. And that comes to 100 units. The margin of safety then will simply be our current activity, which is 650. That's C for current. Break-even point, we just said, was 100. So the drop in units would be 550. That's the margin of safety. Our activity level can drop 550 units before we break even. And if we put that into percentage terms, that would be 550, the drop in units, over our current activity of 650. And that comes to 0.846 or 84.6%. So the final statement is true. There we have it. Guys, that is a challenging scenario. Mylo, checking risk and uncertainty. Remember your time management rules. When the 17 minutes is up, stop what you're doing and go get easy marks in the next scenario.